Investing is about growing your money over time. It's a journey that requires patience, strategy, and a clear understanding of your financial goals. But you know, every investment carries some risk. The market can be unpredictable, and it's important to be prepared for ups and downs. Before you invest, you must understand the potential rewards and the risks involved. This means doing your homework and possibly consulting with a financial advisor. Higher potential rewards often come with higher risks. It's like riding a roller coaster. The thrill comes with the possibility of sharp drops. Conversely, lower risk investments typically offer more modest returns. These are like the steady, gentle rides at an amusement park. Less exciting, but more predictable. Think of it like a seesaw. Balancing risk and reward is crucial to a successful investment strategy. On one side, you have the potential for your money to grow significantly. This can be incredibly rewarding and can lead to substantial financial gains. On the other side, there's a chance you could lose some or all of your investment. This is the inherent risk that comes with the possibility of high returns. Your job is to find the balance that makes you comfortable. This balance will depend on your financial goals, risk tolerance, and investment timeline. This is where knowledge comes in. Educating yourself about different investment options is key to making informed decisions. The more you understand about different investments, the better equipped you'll be to make informed decisions. Knowledge is power in the world of investing. This guide will equip you with the basics of stocks, bonds, and diversification. Understanding these fundamentals will help you build a robust investment portfolio. Remember, investing is a marathon, not a sprint. It's about long-term growth and making decisions that will benefit you in the future. It's about making smart choices today to secure your financial future. With the right knowledge and strategy, you can achieve your financial goals and enjoy peace of mind. Savi. Stocks represent ownership in a company. They are essentially a claim on the company's assets and earnings. When you buy a stock, you're buying a small piece of that company, also known as a share. This means you become a part owner of the company. Companies sell shares to raise money for growth and expansion. This capital can be used for various purposes, such as developing new products, entering new markets, or paying off debt. As a shareholder, you can potentially benefit from their success. This can come in the form of dividends or an increase in the stock's value.
Take Apple, for example. This tech giant has been a favorite among investors for years. If you had bought Apple stock 10 years ago, your investment would have grown significantly today. The company's stock price has seen a remarkable increase. This is because Apple has consistently released innovative products and grown its revenue. Their ability to stay ahead of the curve has made them a market leader.
Amazon is another example. This company has revolutionized the way we shop and use online services. Their stock price has skyrocketed due to their dominance in e-commerce and cloud computing. Amazon Web Services in particular has been a significant driver of their growth. These are just two examples of how investing in stocks can lead to significant returns. Many other companies have also provided substantial gains for their investors. However, it's crucial to remember that stock prices can go down as well as up. The market can be volatile, and prices can fluctuate for various reasons. If a company faces challenges, its stock price may decline. Factors such as poor management, economic downturns, or increased competition can negatively impact a company's performance. This is why it's essential to research companies carefully before investing and to diversify your portfolio. Diversification can help mitigate risks and protect your investments.
Bonds are different from stocks. While stocks represent ownership in a company, bonds are a form of debt. When you buy a bond, you're essentially lending money to a government or corporation. This makes you a creditor, not an owner. In return, they promise to pay you back the principal amount plus interest over a specified period. This interest is usually paid at regular intervals.
U.S. Treasury bonds are considered among the safest investments because they're backed by the U.S. government. This backing provides a high level of security. They typically offer lower interest rates than corporate bonds, reflecting their lower risk. The lower risk is due to the government's ability to raise taxes or print money. Corporate bonds issued by companies generally offer higher interest rates to compensate for the added risk. This risk is associated with the company's financial health and market conditions. The riskier the company, the higher the interest rate they may offer to attract investors. This is because investors demand higher returns for taking on more risk. Bonds can be a good addition to a diversified portfolio, providing a steady stream of income. They can balance the volatility of stocks and offer more predictable returns. However, it's essential to remember that bond prices can fluctuate, particularly in response to changes in interest rates. When interest rates rise, bond prices typically fall and vice versa.
The world of investing extends beyond stocks and bonds.
Real estate, for example, involves buying, owning, and selling physical properties. It can provide rental income and potential appreciation in value, but it also carries risks like market fluctuations and property maintenance.
Commodities are raw materials like oil, gold, and agricultural products. Investing in commodities can be volatile as their prices are influenced by global supply and demand.
Mutual funds and ETFs, exchange-traded funds, pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. They offer instant diversification but come with management fees. Understanding these different asset classes can help you make more informed decisions about where to allocate your investment capital. Section 5. Diversification. Don't put all your eggs in one basket. Diversification is a fundamental principle in investing. It means spreading your money across different asset classes such as stocks, bonds, and real estate to reduce risk. Imagine putting all your money into a single stock. If that company performs poorly, you could lose a significant portion of your investment. However, if you spread your money across various investments, the poor performance of one is less likely to be devastating. Diversification helps cushion your portfolio against market volatility. When one asset class is down, another may be up, balancing out the losses and potentially leading to more consistent returns over time. Section 6. Building a balanced portfolio, a sample for beginners. A well-diversified portfolio for a beginner investor might include a mix of stocks and bonds. For example, you could allocate 60% of your investment capital to a low-cost S&P 500 index fund. This fund tracks the performance of 500 large US companies, providing broad exposure to the stock market.
The remaining 40% could be allocated to a diversified bond fund, offering exposure to various types of bonds. This mix provides a balance between growth potential and stability.
Section 7. Tailoring your portfolio, risk tolerance, and your financial goals.
Your ideal asset allocation depends on your risk tolerance and investment goals. Risk tolerance refers to your comfort level with the possibility of losing money. If you're risk-averse, you might prefer a more conservative portfolio with a higher allocation to bonds.
Conversely, if you're comfortable with risk and have a longer time horizon, you might opt for a more aggressive portfolio with a higher allocation to stocks. Your investment goals also play a crucial role. Are you saving for retirement, a down payment on a house, or your child's education? Your time horizon and the amount of money you need will influence your investment choices. Section 8. Navigating today's market, how current events impact your investments. It's essential to stay informed about current market conditions and how they might impact your investments. Factors like interest rate changes, inflation, and geopolitical events can all influence asset prices. For instance, rising interest rates can negatively impact bond prices, while inflation might erode the purchasing power of your cash holdings. Geopolitical uncertainty can lead to stock market volatility. By staying informed about these factors, you can make more informed decisions about when to adjust your portfolio and mitigate potential risks. Section 9. Knowledge is power, making informed decisions for your financial future. Understanding the basics of stocks, bonds, and diversification empowers you to make informed investment decisions. By carefully considering your risk tolerance, investment goals, and current market conditions, you can create a portfolio that aligns with your financial aspirations. Remember, investing should not be based on emotions or speculation. It's about making strategic decisions based on knowledge and a long-term perspective. The more you understand about the markets and how they work, the better equipped you'll be to navigate their complexities. Section 10. Stay agile, stay informed, adapting to the ever-changing market. The financial markets are constantly evolving. New investment opportunities emerge and economic conditions shift. It's crucial to stay informed about these changes and adapt your portfolio accordingly. Regularly review your investment portfolio to ensure it still aligns with your goals and risk tolerance. Don't be afraid to make adjustments as needed. Consider seeking advice from a qualified financial advisor if you're unsure about how to navigate the complexities of the market. Remember, investing is a journey, not a destination. By staying informed, diversifying your investments, and adapting to changing market conditions, you can position yourself for long-term financial success.